Hello, this is Dana Grigg. I'm happy to present the results of the first half of 2023. What if I told you in January that interest rates would finish this quarter almost 5 to 6% above where they were a year ago, that we would see a banking crisis where we lost First Republic, Silicon Valley Bank, and Credit Suisse, plus China would have trouble reopening their economy post-COVID. And yet, in spite of all this, the market had one of the strongest performances that it's had in recent history. Would you believe me? Well, that's what happened. So, what's going on? Many attribute the market performance to 10 stocks, 10 strong stocks, many of them seeming to have an artificial intelligence or AI narrative surrounding them. But in fact, that doesn't explain why 3 of the top performers in the top 10 were Carnival Cruise Lines, Norwegian Cruise Lines, and Royal Caribbean. So what's really going on? Well, as we talked about last quarter, in spite of the rising interest rates, we are seeing massive amounts of money still being printed by global central banks, specifically the Chinese central bank, continuing to try to stimulate their economy out of their zero COVID policy. And as liquidity flows have determined investment returns in the first half of the year, that's going to continue into the second half. If liquidity continues to flow into markets via the money printing mechanism, you're going to continue to see markets rally. But unfortunately, in the data, we're actually seeing a reduction in the amount of money being placed into the global economy. And so that, combined with certain pressures from inflation, might lead the markets to pause or slow down a bit. As far as the way we invest, we're always looking at where we stand in the economic cycle. Are we in an early boom, early bust, or late bust? And not only that, we want to align our investments with those particular parts of the cycle. For example, in boom times, you'll see stocks that are a little more risky and a little more aggressive doing well, like the Carnival Cruise Lines of the world. At the same time, during a recession or a slowdown, you'll see stocks that are a little more stable, like a utility that's going to get checks from their clients of about the same amount in good times and bad times. So they have stable earnings, but not a lot of upside. So all of these are included in the S&P 500, which has 11 different lines of business or sectors. And what we want to do is get away from the S&P's weighting towards capitalization, meaning the more money that's invested in your company, the bigger the share of the S&P you have, and instead look more at weighting towards the businesses that align with the economic cycle. If we're in a recession, we want to overweight utilities and we want to underweight things like Carnival Cruise Lines and vice versa. So looking forward, as we see a slowdown, we're a little more defensive, and we're keeping our eye on the liquidity that seems to be the narrative that's driving markets. Thanks a lot, and I invite your questions or comments.